Hey, welcome back, everybody, to another episode of Alt Reports Radio, and I'm really happy to be on here today with a guy who we've known of each other and sort of known each other for years, but we've never sat down to talk. And so I'm thrilled to have him on here. Chris Sevigny, did I say it right? Sevigny?
Yes, you did.
Okay,
yes,
right on.
Did. Thanks.
I got some coaching beforehand, so and I was told it's like the number and the letter 70, and I was okay, perfect. I'm going to get that right when I get on there. Chris is in the mortgage note space, and I know that we've had a lot of interviews about that here, and the reason is because I really like it as an investment for a bunch of reasons, which hopefully Chris will unpack for us a little bit today, why he's invested in them and why he's building what he's building over there. So Chris, thanks so much for jumping on here. Really appreciate it.
Yeah, and thank you for having me today. So it's an honor and privilege to be here.
Pleasure's all mine. So I have seen your name around for years from DistressedPro.com, which is my last business. And you have been quietly, or maybe not so quietly, building an empire over there that I would love to hear about. If we could just go back, though, and rewind, could you tell us a little bit about how you found this investment space?
Yeah, kind of by luck, to be honest. About 7 years ago, my wife and I were building out a rental portfolio. And we had kids at the time. And after doing a few, rehabs on those rentals and then get them rented, my wife looked at me and it's like, okay, we can't do that anymore. Too much going on the weekends. And, so I got the no from her. And I was looking for, alternative investments that you could invest in, and something that was, I'll say, active, but less active than flipping or trying to rehab a property. And at first thing that came up, I was on website BiggerPockets, which probably many people have heard of. And first thing I started looking at was tax liens. And then when I was analyzing that, I'm like, it seems too easy. Too many people can, there's not a lot of strategy, game theory type involved with it. And then I stumbled across note investing. And it kind of, to me, at first I got upset because, I graduated college in the mid 90s to age myself, and I'd been in real estate, I'd been in construction, and I'd never heard of note investing. So I was like, how did I knew of private lending, but I never knew you could buy distressed debt. So I was kind of a little bit upset, but, then once I started diving in to it and understanding. Yeah, upset that I missed it. Yeah, I was upset that I missed it. That I was like, I wish I would have done this, again, back in 2010 or 8 or something.
Sure, yeah.
So yeah, I was upset that I missed the opportunity or didn't know about this. So so that's how I kind of got started. And being an engineer by background, I kind of overanalyze things to the nth degree before I started buying notes, which I bought my first note in 2016. And since fast forward to today, we bought over 500 notes.
Wow. So tell me about that first deal. How did you take the plunge? Where did you source it and all that?
Yep. So it was sourced from somebody you probably know, Paul Burkett.
Okay. Yeah,
who
sure.
Ran a company, Automation Finance at the time. Might be under a different entity now. And I was using my, at the time, again, another thing that upset me was I had switched jobs recently, and I always was told, hey, you got to take your retirement account and move it from one company to the next. Yeah. And I moved it to, basically a self-directed account where I managed the money. So I bought 4 notes that were all low balance off Paul. One of them was in bankruptcy, 2 were non-performing, and 1 was performing. And my all in between the 4 was like 25 or 30 grand. I mean, the balances on these were probably like 40, 50,000 total. So I started basically by like, okay, I didn't JV with somebody. If I'm going to go in, I'm going to lose. I'm only going to lose a few $1,000. But hey, let me go through. And to me, kind of being the type of person who wants to try and conquer the world off the bat, let's try bankruptcy. Let's try a non-performer. So I just dove in. Yeah.
Wow. That's awesome. How did those perform for you?
Actually, they performed well. I ended up, the one of them, basically one of them, I may have made like $200, which, basically nothing.
Yeah.
The performing one just kept performing and paid off early. And then the one in bankruptcy did well. Overall, I mean, combined, I made a double-digit return on them. So instead of going to pay somebody, $5,000 to learn, I ended up making, probably about at the end of the day, maybe $3,000-$4,000 on those investments, and got a really good education.
Nice. Yeah. It's learning by doing is certainly the fastest. Might not be the best all the time, but it's certainly the fastest way to get your hands dirty, roll up your sleeves. Mm-hmm. So tell me about how you went from that to snowballing. Now at some point you moved on from just operating with your own account, right? And started raising money. Talk a little bit about how that happened.
Yeah, I've always had a long-term mindset and understanding that it's always a process. And, I bought those first few notes, and then I went to a bunch of seminars. And what I started eventually doing initially was the joint venture route, where I would meet people at seminars and basically reach out to them and say, hey, look, if you find this too overwhelming, let's JV and we'll partner together. And with my initial investors, as you know, previously, most JV deals were like a 50-50 split. Yeah. So what could I offer somebody? So I was offering 60%. So I'm like, okay, I'll give you 60, I'll take 40. And to them, they look at it as a lot. But if you take a $25,000 investment, and let's say you make 20% on it, which is $5,000, instead of giving them $2,500, I'm giving them $3,000. So I'm cutting myself out $500, which I was also working full time. So to give away an extra $500 to get that money in, I was looking at it as a win. So that was kind of one of the things, that I did differently. And, throughout my career, I like to think I zig when others zag. But all of a sudden, it just starts snowballing, where now I get 1, then 3, then 5. And next thing you know, after about 18 months, I had like 40 JV partners. Wow. And all of a sudden, I realized this is too much because each partner is like its own individual company. Yeah. And then what I did is there was an asset tape came out of a bunch of, at the time, land contracts. And basically it was about $1 million acquisition. So I reached out to all the people I JV'd with and said, hey, look, do you want to partner and go take this down? So in the span of 2 weeks, myself and Gail Greenberg at the time went and raised $1 million to take down basically like 70 assets. Wow. And that was our first kind of fund. And what set us up, I think, for success on that was 6 months prior, I'd reach out to my attorney. I said, can you just draft documents for a Reg D offering just to have them just in case and so forth. So it allowed us to literally, everything was already done. All we had to do was name the company and kind of put in the types of returns. And I kept it simple, stupid, where it was just that fund was a 50-50 split with investors. Yeah. So it just made everything, it's like, hey, we're just taking the JV individually, rolling them up at a ball and putting it into one entity.
Wow, that's awesome. So if somebody's listening to this, they've never heard Reg D, you talk a little bit about what that means?
Yep. So it is, the SEC, the Securities Exchange Commission. When you're raising funds, there's multiple ways you can do it. And Regulation D is an exemption, meaning, there's several different classes. There's a 506, and this will use 506C, which allows the sponsor to advertise for the deal, but the investors have to be accredited, meaning they have to have either net worth over $1 million outside their primary residence, I believe. I can't recall if it's primary or not, or $250,000 income, or $300,000 if joint couple. So, by doing that, you file with the SEC, but you don't have to, go through as much regulations as public companies do, or some of the other types of offerings that are allowed. The caveat to it is, though, your investors have to be accredited within that investment.
Okay. And so you did that first one, that went pretty well?
Yeah, that one actually... I think I spoiled some of the investors because the company I was selling it just needed to liquidate them. So we got these at a steal. So that one went well, but it snowballed into another one and another one and another one that we kept, doing them. And one of the things I did early on was when I was doing these Regulation D offerings, instead of just going to raise 25 million, I'd raise a few million, because I would also change some of the parameters. What's the preferred return versus a split, to kind of measure and see, basically so I can fine tune for the future. Because in one of them, for example, I'll be honest, I gave too much pref. And during the fund, I basically had I had a management fee, but on, the percentage based on the amount raised, it was pocket change essentially. So I basically didn't make any money in that one till the end. So it's like, okay, lesson learned. And so in that, so by doing them, in smaller increments and trying different numbers on things, it allowed me for my the one I'm running now to really fine tune and model it to for a more successful campaign.
Wow. So in case somebody hasn't heard the term pref before, can you I just want to make sure we dot I's and cross T's while we go through.
Oh, no worries. So it's the preferred return, which it's the money that goes to, the investors. So, the profits that come in the door, depending how it's structured, usually there might be like a management fee that the sponsor takes. And then the first, I'll just use 10% as a number because it's easy to say. First 10% of profits go to those investors. And then there's what's called a waterfall potentially, which is the money after that, how does it flow downhill, which is where the term waterfall comes from.
Cool. Thank you for doing that. What I'm really trying to do with this show is, a lot of the folks who are listening to this have not been in alternative and private funds before. And now with the way the markets are and all that is, they're more interested. And I just want to make sure that we educate folks as we move through this. So really appreciate that. So then where does that bring us to today? So at some point you quit your job.
Yes. So earlier this year, I left my job, and what predicated that was our latest fund that we launched, which is a Regulation A+ offering, which is very different from a Regulation D offering. Because we have to get qualified by the SEC. So we had to go through the SEC to have them, they don't approve you, they qualify you, which let's just say it's like having your English teacher in 7th grade grade your book report. Not only are they reviewing the terms, but literally like, well, this is on page 7, but why isn't it on page 2? And then you go do that, and then they come back and say, great, you fixed that one, but now on page 10, it's like going to the DMV almost, your motor vehicles, and saying you want something, like, well, you're missing this, and then you go and you bring it to them, well, now you're missing this. Instead of giving you the full list, it's like once they find something wrong, they like cut you off there.
Sounds like the government.
So what it allowed us to do is we can market to accredited and non-accredited. So anybody over the age of 18 can invest. It's almost, some people will call it like a mini IPO, because you're buying shares of the company, but it's privately held. But also the investment amount is very different. In a Regulation D, typically your investment amounts might be 25, 50, 75,000. Our minimum is $500.
Is there a maximum also?
No, there's no max. The max is 75 million, which is the max you can raise.
Okay, so I was going to say, I was going to ask if there was a max on the other side. So, so that's really interesting, because I haven't seen anyone who's able to, I haven't seen anyone in the mortgage note space who's been able to work with non-accredited investors at all. I don't know anybody else who's doing an A+. Are you the only fund that you're aware of that's offering this?
There is one other, which AHP Servicing, who's their servicing company actually is run through this type of offering. Their minimums, I think, are very similar. And there's different ways you can do this. Like for us, we went through the route of, we have a broker dealer. that actually, we gets us licensed or passes us in all the states because, as you raise money in different states, there's different blue sky laws, they call them. We had to get an escrow company where all the money goes to. We actually have what's called a transfer agent, which is a company that records all the shares. So all the shares get sent to them. So it's on their historical database. So if my computer is burnt down or, something happened, to the company, someone's like, hey, I still have those shares, and it's, in a licensed company that manages all of that for us. So
this sounds like very expensive regulation to get into. Is it?
Yeah. Yes. So the upfront fees, so Regulation D offering, you can get in, I'll say between like 10 to 25,000 to get the PPM and everything put together. Typically for this type of offering, you're going to be anywhere from about 100 to 250,000.
Wow. Huge difference.
So, yeah.
So let's talk a little bit about, I want to talk about a couple of things. One is the thesis there that you have, and obviously this is mortgage notes, and I think I probably go on about mortgage notes a bunch at Alt Reports, but help me understand what kind of notes you're looking to buy, where you're sourcing them. Are they non-performing? Are you getting them reperforming? Like, let's just walk through them, like what your box looks like for what you're investing.
Sure. I laugh when you mentioned thesis, by the way, because I was getting my master's during COVID at Georgetown, and it was real estate finance was my degree. And my master's was raising $50 million to start a note fund. So literally my whole business plan, basically, so I enjoy sharing that story. So our business plan is, we're buying non-performing and performing. I like to keep about a 60, 40, 70, 30 split, 60, 70% non-performing, 30, 40% performing, to mitigate risk, but also get some of that cash flow coming in the door. So that, we've invested in over 40 states. We're somewhat state agnostic. There's states like New York that we're much more careful in, and there's certain counties we may not invest in, like certain counties in Illinois or certain counties in New York, just because of the time that it may take. And time is in note investing is a big risk, because if it takes a lot longer and you're paying, basically, your interest on those, to investors, that can have some significant impacts.
Now, when you say it takes a lot longer, do you mean to take action against a default, or is that where
Yes.
Yeah.
So if you wanted to take action on a default, and you have to go through the legal process. Now, our whole business plan is to try and keep the borrowers in their home. Most investors will tell you it's more profitable to keep somebody in their home and modify a loan than it is to foreclose if you're modeling it and buying it right. But you still have to take into account the worst case situation of, if I do have to go legal, and certain areas in New York, if you can't go through the federal court and go through the state, it could take 3, 4, 5 years. And then you may foreclose, but then you have to evict that person. And there was an article in a magazine recently about, I think it was a doctor or somebody who it took him like 20 years to evict or something like that. And finally they evicted him after, it made news headlines.
Yeah. So tell me a little bit about then. I get why you're doing that mix. And so you're buying the non-performing at a discount. This lets you get a better yield. Talk a little bit about where you're sourcing deals, if you can, without naming names, of course. But one of the things that's been sticky in the note business for a little while is that where there's been just inventory product issues. And some of that was all of the like crazy government interference through the COVID and all that, with the forbearances and everything else. And so that really kind of stopped up the works for a while. Tell me a little bit about how you're getting enough product to do this size. Deal.
So a lot of it is, relationships built over the last 5 or 6 years. From certain funds that we bought from in the past, but even some of those funds have gone and closed shop to look into alternative other types of investments. And lately it's been also, there's several I'll say, I don't want to I'll call them brokers, but there's several large companies like some names like a Mission Capital or
Sure.
First Financial, who they are they're brokers, aggregators, where the banks and large funds will send them the portfolio and they will solicit it out to their individuals.
Yep.
And it's interesting because, 3 months ago, the inventory supply was very low. And also pricing was higher than average because having a non-performing note was not really hurting your bottom line because the property was appreciating. Now, where I think everyone can see where real estate prices are starting to head, and now it makes sense for those companies to try and liquidate. And there's still some sellers who are on February pricing and some who are in today's pricing. But, since last Thursday, I have literally gotten sent to me probably over 1,000 assets and about 300 million in assets that different entities are looking to liquidate, which this time of year, it's common because people want to get stuff off their books. But, and I've seen a lot in the past, but this year, the last 2 years with COVID, it has been very, very limited. Now it's like the floodgates seem to have been opened. But I also think people are looking to also stockpile some cash because during recessionary periods, cash is king.
Yeah. So what size pools are you taking down? What is the total amount that, do you have a target for this fund for the end size, or does it roll, or how does that work?
Yeah. So we're allowed to raise up to 75 million per year. And so we got qualified in mid-July. So that's when we were started to raise money and we started our marketing effort at that period of time. Right now, we've got a little over $6 million raised. We've already bought over $2 million in assets. And we've got another, million plus under agreement we're doing due diligence on right now. And we just, every month, we close. So last month in October, we just, we raised about $1.5 million last month. So now that money is actually hitting our accounts today. We're bidding on assets now. So we're looking right now at pools, 1 to 2 million. And as we ramp up into next year, that's probably going to grow to pools of like 5 to 10 million. As our marketing effort continues to grow, we continue to spread the word about, our offering and educate people about, what it is we're doing and some of the differences that we've done on note investing with our investors, and some even down to the tax benefits that we can provide to investors as well.
Well, so that's a good lead in, because my next question here for you is I want to talk a little bit about your edge. Like, why you? Why you guys? Why 70?
Yeah. So, by doing the Regulation A offering, we now have 100 million plus people who can invest with us, where when you're doing a Regulation D offering, you're really only real people who are looking for alternative real estate who are accredited. So we've, our pond is much bigger. We've had very low minimums. One of the other interesting things, and I know you've invested in notes, the way we structured our corporation, and I can't provide tax advice, I got to make that stipulation, but we structured it as a C corporation. So investors should receive a dividend, which is taxed at the dividend rate, not the ordinary income rate. So we will pay the corporate tax, but to our investors, now all of a sudden, our shares start at 8% monthly, 8% paid monthly. But when you look at, an investment that is at 10%, and if you're at that 37% tax bracket, your gross is 6.3. Our 8% at 20% is actually 6.4. And in those funds, if you're investing 50 grand, our 50 grand actually gives you bonus shares as well. So that's one way we looked at it, is to give people that tax advantage that I have not seen anybody else do in the note space. So that's kind of one edge. The second edge is kind of like we said, you can start with $500. So you can start with, hey, let me see if this is real, let me invest 500. And then if, you're comfortable with it, you can invest more. Again, we're both investors. When someone says, hey, you're going to invest 50 grand, I don't care how much money you have. That's still a little tough pill to swallow. If someone says, hey, $500, I mean, it's half the price, it's 50% the price of an iPhone. Most people can, it's easier to get over that hurdle.
For sure.
So those are some of the edges. We've also built a staff. It's myself and 8 other individuals who work with us. We have a separate investor relation team. We have an asset management team, and we've got people, and myself who are heavily involved. And the other differential I'll say is compared to some of the larger funds, we touch every asset. We work every asset. Okay. We don't have 5,000 assets and we're breaking them out at portfolio level. Every asset I can tell you the story to.
Yeah. And so you guys do all the individual workouts. So give me just an example of, just so somebody understands sort of the numbers on maybe an individual note, what the strike price may be versus what the face value, and then how you structure that so that you have a win.
Yeah, actually, this is fresh in my mind because I just did a webinar today for our investors and we did 2 case studies. So this one's easy. So we did a case study where it was an asset that had the $85,000 was UPB with payoff,
which is unpaid principal balance.
Unpaid principal balance.
Yep.
So they basically owed $85,000 on the loan. Keep things simple. The property was worth about $120,000. Okay. So they had a little bit of equity because the loan was originated around 2012.
Yep.
And we bought that loan for $45,000. So we basically paid about 55 cents on the dollar.
Yep.
And it was about 18 months delinquent. So they were behind. And we like to, paint the picture of trying to understand why when we're bidding on these. If somebody's filed bankruptcy 6 times, we're probably not buying that asset because, lucky number 7 for them. Yeah. But, when you're bidding and stuff, sometimes you can, get some of the information or after, and the borrower had cancer and they had lost their job, and they were recovering. So it wasn't something that was, going to be fatal, but they were out of work. And anybody who's ever been on disability, they don't cut you a check that day. It takes a little bit of time. And unfortunately, this person had other bills. But, we bought that note. Their payment was roughly about $900 per month. And what we did was we dropped their payment down to $700. We modified the loan to bring them current so they're not paying late fees and everything else. They paid for about 18 months. So we collected about $12,000 during that time. Then we sold that loan, which was at about the 2-year mark, and we sold it for about $65,000. So over 2 years, we had some expense. You always have expenses. So let's say we were in it for 50, but over 2 years, we ended up, basically at 75,000. So annualized, it was about a 25% return per year over that asset, which kind of fits that box. We target when we're bidding to hit that mid, 20-25% on these non-performers because of the risk involved.
Right. And so, but that's not your total return for the fund, because you've got employees and overhead and all that kind of thing.
Correct.
So what are you targeting for a return for what do investors expect or hope to get?
Yep. So we that started at 8%, and it can creep up based off of the investment amount. And that's kind of, the pref. We don't have a waterfall. But we can provide, additional dividends. And the reason why with the waterfall, because it's an open fund, it's, you have to all of a sudden have a net asset value of every month, and you have to price every asset, because let's say you invested in month 1, I invested at month 11. At the end of the year, if you were issuing additional funds, well, how do I, what's your percentage versus my percentage?
Sure, yeah.
And to do that within the SEC and the type of auditing and so forth that would have to be required. Yeah. It was something that, was very difficult. And one of the things I'll mention to people, anybody who's out there who's looking to be a sponsor, and you're raising money, one thing I'll mention to you is you have to keep things simple. Yeah. You have to allow the investor to understand what it is you're doing, and especially in mortgage notes, because most people don't understand mortgage notes. They think you're buying the property. So when you tackle how do you understand mortgage notes with a very complex payment system? Yeah. Most people are gonna be like, I'm just going to go somewhere else. Yeah,
sure. So, so we're talking about a $500 minimum and 8% monthly dividend as a target.
Paid monthly. Yep.
Paid monthly. Wow. Yep. And what about liquidity, or what's the hold or lockup period?
4 years.
Okay.
So we put the lockup for 4 years, which will allow us to, go through several rounds. On the non-performing side, a typical non-performing note will take about, could take up to 2 years.
Okay.
And then after that period of time, you can stay in. The company is still going to continue to operate.
Yeah.
But we wanted to make sure we had people not coming in 1 month and then leaving 3 months later, because we don't want to be forced to, when you have funds like that, you can hurt your current investors, because all of a sudden, if you have to start liquidating stuff, you might be liquidating it not at a right time or at the right price.
Yeah, for sure. And so tell me a little bit about what you see as the risks in this model, because nothing's without any risk, right? We don't get a return for zero risk.
Yeah.
And are you only in senior positions, and tell me a little bit about how you're mitigating any risks that there are.
Yep. So several risks. One is when you raise a lot of money, you need to make sure you can invest that money. It just can't sit in the bank account.
Yeah.
So our primary focus is on first position senior liens, which are, I typically haven't got involved in seconds, which are considered like home equity lines of credit.
Yep.
The way we wrote the offering with the SEC was it gives us flexibility. And what I mean by that is we can invest in single family rentals. We could do a fix and flip. So we left it open, broad enough where, say the note market completely dried up and I had $50 million, I would have to return it if it was strictly notes, but we left it open to do other types of real estate. And my background my career has been in real estate. I've, done commercial construction. So I have that background. So I'm comfortable being able to make all of those shifts, and it gives us that ability. So that's one way. That's one risk, of course. Everybody's right now worried about, the economy and house prices.
Yeah.
So we look at, the risk involved if asset values start being compressed. So one way we mitigate that is right now we're putting in price damage on the asset value. If I'm buying an asset from you that you say it's worth 200,000, I'm probably putting that in as worth 250. If you say 200, I'm saying it's probably worth about 160.
Okay.
In a year's time. So, those are some of the risks. Without getting into all the nuances of note investing and all the due diligence you have to do as part of that, the attorneys involved in reviewing collateral, insuring properties, checking taxes. There's a lot of processes that we go through to mitigate risk. But the major risks right now, of course, are, if you raise the money, can you invest it? And then what is going on with the global markets? I think are the two biggest risks everyone's focused on. I will say one of the benefits with notes compared to traditional real estate, though, is, that example that I mentioned where the person owed 85, property is worth 110, we bought it for 45, is if house values drop by 30%, the assets were 75,000. My investment's still only 45,000. So we still have your equity covered. Now their loan might be a little bit underwater and we might not be able to collect as much, but typically we like to make sure, there's equity in the property so we can protect that, initial investment. Yeah.
It's a great time to be low in the stack.
Yeah.
As we're heading into this, I think. So go ahead.
I was going to say, and, we joke with people when you say, you drive through any major city, who's got the biggest building in the city? It's usually a bank.
Yeah.
And that's what we do. So, essentially we are banks.
Yes. Well, so who should invest with you, and where should they find you?
Yep. So they can find us at invest.7einvestments.com. And that's the number 7, the letter E, investments.com. And, anybody can invest. So if it's something that you're looking to alternative investment, maybe you got some money in the markets that you're looking to move out of the markets, or, the multifamily syndications you're looking at right now, you might, some people might be a little nervous about some of those. You're looking for diversity. Like I said, with that minimum $500 investment, we really wanted to open it up to everybody, especially people who have like self-directed IRA money where they might only have an HSA, or they might have just started and put $5,000 or $6,000 in that account. This is a place where you can invest in real estate or invest in something that can give you some alternatives to your traditional other styles of investment. Yep.
At 8%, secured by first position, that's like low on the LTV, is, I think, a no-brainer for me. So appreciate you coming on here, Chris. It's been awesome talking to you, and so happy for you that your business is flourishing like this. Like I said, seen you around for a long time, and you've really just blown the whole thing up, and I think it's just fantastic. So appreciate you getting on here and talking about it today.
Thank you for having me, and thank you for the kudos as well.
Yeah, my pleasure.
Thank you all.